Back in 2008, financial institutions that were supposedly too big to fail were the first ones to be rescued. Their bailouts were followed by heavy regulations to make sure those banks ran more safely. All the policies put in place, however, missed something important. No new regulations were enacted to help smaller banks secure their business and help them grow. Many of the banks that have been failing are regional banks. Regional banks are institutions between $10 billion and $200 billion in assets. Silicon Valley Bank and First Republic Bank each had $200 billion in assets when they collapsed. Regional institutions are a key source of financing for small businesses. Small businesses employ about half of the private sector workers. Yes, half. If regional banks are not supported enough, then it can make it even harder for these businesses to borrow money. There'll be no choice but to succumb to bigger banks, leading to this monopoly. Then there's the stimulus trap. When the government gave away stimulus money, a lot of it ended up in bank accounts. Because prevailing interest rates were so low, banks were under little pressure to reward customers with higher interest rates in their savings. However, while depositors were and still are getting shortchanged, banks were too. Low yields made it harder for banks to earn money from lending or investing in securities, and demand for loans was low because no one wanted to do anything until things got better. To survive and grow, some banks chased a niche. First Republic went after wealthy customers. Silicon Valley Bank went after tech startups. When these banks looked to deploy the money they took in, they did it in the safest investment they thought they could get, which is government bonds. They also offered loans to wealthy customers with high credit scores. The problem, government bonds have long maturities, and real estate loans expose the banks to interest rate risks. When prevailing interest rates go up, longer dated assets paying lower rates became less valuable. Last year, the Federal Reserve pivoted to fight inflation and started aggressively raising rates. Small banks, small reserves. It would have been okay if banks had the financial fortitude to hold money despite losing securities to maturity. When depositors started withdrawing their money too quickly, banks with too much interest rate risk faced the prospect of having to sell those holdings at a loss. The bigger banks are partly kept safe because depositors know the government will rescue them if they fail. Wall Street banks also tend to have a lot of capital to cushion losses, as well as economies of scale and more ways to move low-yielding assets off their balance sheet, such as securitization or asset sales. Is there a way out for regional banks? One suggestion is for Congress to raise the $250,000 cap on deposit insurance. However, countries with more lenient systems have more frequent banking crises. Looser regulations lead to more irresponsible transactions. Others propose larger capital buffers by boosting profits, cutting dividends, or raising money from investors. However, raising capital may be perceived as a distress flare. This prompts investors to pull their money away instead of buying more. Another suggestion is to revisit how do we deal with inflation. Many believe this is a result of the Fed's tightening. Therein lies the problem. No one has really examined the lack of regulation on how a bank should diversify its assets. Silvergate and Silicon Valley Bank were too heavy on a specific industry and asset. No one has re-examined fractional reserve banking and how to revise this regulation. More banks will most likely follow and will continue to stand on shaky ground until regulators actually start revisiting the totality of our banking policies. Diversification is the best solution. Banking regulations need to evolve, but you can't wait on that to protect yourself. You need to make sure that if you feel your bank is not safe, you have assets outside of government control to truly protect your wealth and continue to grow it with the current instability. Gold is the asset that billionaires, multimillionaires, and central banks run to. Gold is not controlled by any government and is truly global. It's just as desired and needed in this country as it is in other countries. When everything goes south, you want to have assets outside of the hold so you can protect your family and grow your investment in the future.